Hello everyone, welcome to another edition of Compass, the sectoral chart book from DSP Mutual Fund. My name is Chirag Dagli and I cover the healthcare sector at DSP Mutual Fund. The healthcare sector is 2.4% of the broader indices profit pool and about 2.7% of the market capitalization. Today, I will discuss the outlook of the pharmaceutical sector within the healthcare space. Broadly, the pharmaceutical sector can be divided into the India business and the exports business. And I shall discuss the outlook on both these subsegments. The Indian market has been growing at between 9 and 11% for the past many years, driven by about 4 to 5 percentage points of growth from prices, while new products contribute about 2.5 to 3% of the growth. Volume growth has been volatile in the past as there has been some disruption in FY21 due to COVID. Thereafter, there has been some volume growth in the first quarter, which saw a big boost to the overall numbers due to new treatments available for COVID in the second wave. This has then subsequently now normalized, and the trend is back to normalized growth of back to 9 to 10% kind of growth. The Indian market for our companies is very important as it provides the cash flows to grow in the longer gestation exports market. Pharma formulations exports is a long gestation business because companies have to invest in development of products, submit the applications of these products to the regulators for approval, set up factories to make these products at scale, and then provide for working capital. All this could take anywhere between 3 to 6 years from the start of development of the product to actual commercialization. Importantly, most of the capital is already sunk in by the time the products come to the market, thus making the business high gestation business. The biggest of the exports market is the generic market in the United States of America. This chart here shows the aggregate sales in the US of the top 10 Indian generic companies. As you can see, we had a stellar growth from FY10 to FY15 when sales went up for our companies went up 4 times. Thereafter, over the next 5 years, you could see over FY16 to 20, sales dipped a bit and then recovered some bit. We are seeing some signs of stability coming back in FY21 and 22. The US market has also boosted margins. In the initial period between FY11 to 15, when the US contribution to overall sales, as you can see in the dark blue line here, kept going up, the margins for the companies, the one in the green line, also kept going up. Thereafter, while the US sales stagnated, the Indian companies kept on investing in R&D, and this had a negative effect on margins which contracted meaningfully. As is evident, margins eroded through FY16 to 19 and were at decadal lows before recovering in FY20 and 21. The chart above shows the investments made in research and development and in fixed assets, that is factories, etc., by our top Indian companies. As you can see that the investments in R&D as well as in factories went up 2 times over a period of FY16 to 20 when compared to the period 4-year period from FY11 to 15. All this while US sales were largely flat. Naturally, this impacted margins. Now, the logical question to ask is, where did all this investment go? The chart below shows the Indian company's volume share in the US generics market for oral solids. The red line here shows that volume share. Oral solids are your usual tablets, capsules that are consumed orally. As you can see, our volume share in the oral solids market in the US went up from 35% to 50% over 4 to 5 year period. Through this period, the oral solids contribution to the overall market, this is the black line here, also went up similarly. However, there is a part of the market where the Indian market share is low. This is the gray line. These are typical non-oral solid products like ointments, creams, injections, inhalers, products where there is a combination of a drug along with a device. Here, the Indian company's market share is low, and all these investments are geared towards gaining market share in this segment. Coming to valuations, as you can see in this chart above, the BSE Healthcare Index has typically traded at a premium to the BSE Sensex. Over the last decade, there has been an average 35% premium versus the BSE Sensex for the BSE Healthcare Index. However, at the moment, this discount is very negligible, and as one can see that over the past more than a decade, the BSE Healthcare Index has never traded at a discount at a premium this low. Hence, this makes us positive on the sector from a valuation standpoint.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.